What if just $9 a day, less than your lunch, could completely change your financial future? By future, I mean sitting on a $1.4 million portfolio that pays over 10 grand in monthly dividend income. It sounds impossible, right? Most people fail at investing, not because they pick bad stocks, but because they don't have a system. They jump between trends, react to headlines, and end up building portfolios that look busy, but go nowhere. In this video, I'll show you and Josh how to fix that with a system I call the 4 engines of wealth. A simple structured system built around 4 REITs that balance growth, stability, innovation, and income. You'll see how each one is selected using a criteria, the role it plays, and why. Together, they can outperform even the most complicated portfolios. And in the end, I'll show you how this REIT portfolio can turn a $9 daily investment into $1.4 million and pay over 10 grand a month in dividend income. So how does it work? Let's start with the foundation, the concept behind the 4 engines of wealth. Most investors view their portfolio as a list of holdings, but not as a cohesive system. The 4 engines of wealth make that change. It transforms your investments from scattered decisions into a structure where every part has a purpose. Each engine represents one function of long-term wealth creation: growth, protection, acceleration, and compounding. Let's go through them. The market engine focuses on total return, the combination of income and share price appreciation. It captures the steady long-term growth that comes from strong economic sectors. This engine doesn't chase trends. It follows predictable demand, the type of growth that comes from businesses essential to modern life. The stability engine manages risk balance. Its purpose is to create reliability. These REITs produce consistent rental income, often through long-term leases with financially strong tenants. When markets dip or rates shift, this engine cushions volatility, keeping your income stream intact and your compounding uninterrupted. The innovation engine drives growth momentum. It represents expansion and adaptability. Companies with rising revenues, efficient management, and scalable property bases. This engine pushes the portfolio's performance higher, especially during growth cycles, helping offset slower returns elsewhere. And finally, the dividend engine powers compounding. This is the reinvestment engine. It takes the income generated from the other parts and multiplies it over time. Reinvested dividends buy more shares, which earn more dividends, creating a self-reinforcing loop of growth. When all 4 work together, it creates functional diversification. One engine drives, one stabilizes, one accelerates, one multiplies. And to make this structure truly work, it needs an investment vehicle that naturally delivers income, growth, and stability. Which is exactly why this system is built entirely around REITs. So you might be wondering, why build this system around REITs instead of regular stocks? It's a fair question. REITs, or real estate investment trusts, are companies that own or finance income-producing real estate. Things like warehouses, apartments, retail centers, and storage facilities. By law, they're required to pay out 90% of their taxable income to shareholders as dividends. That rule changes everything. It shifts your returns from speculation to structure. Because with most stocks, your returns depend on what the market feels like doing. Prices go up, prices go down. You're at the mercy of headlines and hype. But with REITs, you're getting paid directly from real businesses that collect rent every single month. You're not waiting for someone else to buy your shares higher. You're earning a steady income just for owning them. That's what makes REITs so powerful. They blend 2 worlds that investors are always chasing: growth and income. The rent from their properties funds your dividends, while those same properties usually rise in value over time, creating natural compounding. It's the perfect mix of steady cash flow and long-term appreciation. And here's what's even better: people never stop needing space. We always need places to live, store our stuff, and run businesses. That constant demand keeps REITs relevant through all kinds of market conditions. So when you think about it, REITs give you 3 priceless things that most stocks can't: predictable income, protection against inflation, and the potential for long-term growth. Now that we've got the why covered, let's talk about how to keep this system simple, because simplicity, not complexity, is where real strength comes from. One of the biggest misconceptions in investing is that owning more means being safer. In reality, too much diversification just dilutes focus and returns. Real strength comes from simplicity with structure, knowing exactly why you own what you own. The 4 engines of wealth applies this principle with precision. Instead of owning 20 or 30 tickers that move unpredictably, This system focuses on just 4, each one chosen for a specific role. Nothing overlaps, nothing competes, each engine supports the other. This is what I call functional diversification, not just spreading risk for the sake of it, but giving every dollar you invest a defined purpose. That's how you create balance without overcomplicating things. And simplicity isn't about doing less, it's about doing what actually works and sticking with it long enough to see results. It gives you clarity, emotional control, and steady progress. When your investments have defined roles, you stop reacting to market noise and start building wealth with quiet confidence. Now that the system structure is clear, let's look at how each of these 4 REITs was chosen, and what makes them the perfect engines to power this strategy. A system only works if its parts are chosen with purpose. The 4 engines of wealth isn't just a list of good REITs. It's a structure designed around measurable quality, consistent growth, and smart diversification. Each one of these REITs earned its spot through a simple but disciplined process. There are 3 main things I looked at. I call them the 3 pillars of performance. The first pillar is dividend yield, the cash income your investment produces today. It's your portfolio's engine fuel, providing stability and rewarding consistency. But the focus isn't on the highest yield, it's on sustainable yields backed by strong cash flow and conservative payouts. The second pillar is dividend growth, measured by the compound annual growth rate, or CAGR for short. This shows the REIT's ability to expand income streams over time. Rising dividends aren't just about higher payouts, they signal healthy operations, expanding revenue, and effective management. The third pillar is annual share price appreciation, the growth in a REIT's market value over time. It measures how investors reward consistent performance and growth potential. Combined with dividend yield and dividend growth, this forms the foundation of total return. But there's one more layer that most people miss, and honestly, it's what makes this system special. It's diversification by function. Each REIT isn't there just to fill a space. It serves a purpose. One drives growth, one adds stability, one brings innovation, and one powers compounding. So when one engine slows down, maybe during a rate hike cycle or a market dip, another one keeps pulling the portfolio forward. Next, I'll show you the 4 REIT engines, and at the end, I'll show you how this REIT portfolio can turn a $9 daily investment into $1.4 million, paying over $10,000 a month in dividend income. Alright, let's start with the first engine, the one that drives the portfolio's overall growth and momentum. This is what I call the market engine, and it's powered by a company that sits right at the center of the global economy, Prologis, ticker symbol PLD. Prologis operates at the heart of the global supply chain, owning and managing logistics and industrial properties that enable the storage and movement of goods around the world. From e-commerce distribution centers to manufacturing hubs, Prologis' real estate supports the constant flow of global trade, making it an ideal core holding for long-term growth stability. Over the last decade, Prologis' performance has shown both resilience and scalability. The stock has appreciated by 174.59% over 10 years, reflecting the company's steady value creation and operational expansion. With a market capitalization of $108.21 billion, it stands as a dominant player in the industrial real estate sector. Financially, Prologis keeps things strong and steady. It has a current ratio of 0.62, which basically measures how easily a company can cover its short-term bills using the cash and assets it already has. For most real estate companies, anything between 0.5 and 1.0 is considered healthy, but higher is always good. It shows they're using their money efficiently without sitting on too much idle cash. Its debt-to-equity ratio is also 0.62, meaning it uses about 62 cents of debt for every dollar of shareholder equity. In simple terms, that's a balanced amount of leverage. Not too risky, not too conservative. Generally, anything below 1.0 is a good sign that a company isn't overburdened with debt. And the interest coverage ratio sits at 3.94, which tells us the company earns nearly 4 times what it needs to cover its interest payments. Anything above 3 is solid. It shows Prologis can comfortably handle its debts even if borrowing costs rise. This level of discipline provides both liquidity and flexibility for future growth. Big investors clearly see that strength too. About 96% of its shares are owned by major institutions, pension funds, insurance companies, and asset managers who play the long game. When that many professionals are willing to park billions in a company, it says a lot about their confidence in its long-term stability. The company's top-line growth reinforces that confidence. Prologis's annual revenue reached $8.2 billion by the end of last year, continuing a multi-year upward trend that reflects both organic growth and strategic acquisitions. Analysts agree. Most still see room for upside, with an average price target around $121 and some even going as high as $140. That's why I have Prologis as a growth engine, and once your growth engine is in place, the next step is balance. Because every strong portfolio needs something that can keep cash flowing even when markets get unpredictable. That's where the second engine comes in, the one I call the stability engine, powered by Realty Income. Realty Income is known for its consistent and durable business model, one that focuses on long-term net leases. This means its tenants pay not only rent, but also property expenses like maintenance and insurance. That structure keeps Realty Income's cash flow steady and protected, allowing it to perform across market cycles with minimal disruption. Looking at its long-term performance, Realty Income's share price has climbed 20.67% over the last decade. That may not sound flashy, but is exactly what defines this company's strength: slow, dependable growth built on real assets and recurring rent income. With a market capitalization of $53.79 billion, it stands as one of the largest and most respected REITs in the market. Financially, the company stays disciplined. Its current ratio is 1.5, the debt-to-equity ratio sits at 0.74, showing balanced leverage, and the interest coverage ratio of 2.23 tells us it earns more than double what it owes in interest. Institutional investors clearly see the same thing. Around 78.43% of Realty Income shares, worth over $42 billion, are held by major funds, pension managers, and long-term institutions that care deeply about reliability. And if you look at revenue, it tells the same story. Realty Income brought in about $5.27 billion last year, continuing its pattern of slow, steady expansion year after year. Even during economic dips, its properties stay rented, and its income stays predictable, exactly what a stability engine should deliver. Analysts expect that trend to continue. The average price target is $61.67, suggesting a modest 5% upside, with projections ranging from $54 to $68. Realty Income is the set-it-and-sustain-it piece of this portfolio, and once you've got that stability in place, the next is to add a bit of momentum, something that helps the whole system grow faster when the conditions are right. That's where the third engine comes in, the innovation engine, powered by Essential Properties Realty Trust. EPRT strikes the perfect balance between growth and discipline. Its model is straightforward, yet powerful. It acquires and leases single-tenant commercial properties under long-term net leases. Its tenants are the service-based businesses that form the backbone of everyday life: restaurants, car care centers, healthcare facilities, and essential retailers. The company's track record reflects that focus. Since its inception, EPRT's share price has grown 116.91%, supported by consistent operational growth and prudent expansion. Today, it holds a market capitalization of $5.86 billion, positioning it as a leading mid-cap REIT with clear scalability and a disciplined management team that prioritizes sustainable growth. Financially, EPRT is exceptionally solid. It maintains a current ratio of 2.47, showing strong liquidity to meet short-term obligations, and a debt-to-equity ratio of 0.61, signaling conservative leverage. With an interest coverage ratio of 3.39, the company earns more than 3 times what it needs to service its debt. Clear evidence of both financial prudence and operational efficiency. Confidence in the company runs deep too. Nearly 99.61% of its shares, worth over $6.5 billion, are held by big institutional investors. When almost every professional investor in the room is buying in, it's usually a clear sign that the company's leadership and strategy have earned serious trust. The growth in revenue mirrors that trust. Annual revenue reached $449.61 million in 2024, rising from just $54.5 million in 2017, nearly a tenfold increase in less than a decade. Looking forward, the outlook remains strongly positive. Analysts assign EPRT an average price target of $35.18, reflecting a 19.25% potential upside, with projections ranging between $32 and $38. The consensus rating stands at a confident buy, reaffirming expectations of continued expansion, solid earnings, and dependable performance. In a couple of minutes, I'll show you how this combined portfolio looks, and in the end, I'll show you how this REIT portfolio can turn a $9 daily investment into $1.4 million, paying over $10 grand a month in dividend income. First, let's complete the portfolio. Currently, we have growth, stability, and innovation all in place. There's just one more piece to complete the system, the engine that turns performance into consistent reinvestable income. That's the dividend engine, powered by Extra Space Storage, EXR. Extra Space Storage operates one of the largest and most diversified self-storage networks in the United States, serving both individuals and businesses across economic cycles. Its model thrives on a universal, timeless need: space. Whether people are moving, downsizing, expanding, or simply managing life transitions, the demand for storage remains consistent. That necessity makes EXR's business model incredibly durable. And that consistency shows in its track record. Over the last 10 years, EXR's stock has risen 85.07%, driven by steady growth and dependable dividend payments. With a market capitalization of $31.71 billion, it's now one of the largest and most respected REITs in its space. Its size gives it efficiency and financial flexibility, allowing it to keep delivering stable returns year after year. Professional investors clearly trust it too. About 97.91% of the company's shares, worth nearly $29.74 billion, are held by major institutions like pension funds and insurance companies. That consistency extends to its balance sheet. EXR maintains a current ratio of 2.08, showing it comfortably meets short-term liabilities, while its debt-to-equity ratio of 0.93 reflects moderate leverage aligned with prudent financial management. Its interest coverage ratio of 2.47 further adds to resilience, earning more than twice what it pays in interest, ensuring flexibility even in rising rate environments. Revenue growth supports the same story of steady expansion. As of last year, EXR generated $3.26 billion in annual revenue, marking yet another year of consistent top-line improvement. That growth has been driven by both organic performance and well-timed acquisitions that expand its national footprint, proving the company's ability to scale without sacrificing efficiency or profitability. The market outlook remains confidently positive. Analysts project an average price target of $148.08, suggesting a 3.49% potential upside. The consensus rating of buy reflects expectations for continued dividend reliability and sustainable long-term returns. With this, the portfolio now has all the pillars it needs. Now, the four engines of wealth come together to form a complete self-reinforcing investment system. Each REIT plays a different role, but they all complement one another perfectly. PLD drives the market engine, anchoring the portfolio's growth with a current dividend yield of 3.53%, a 10-year dividend growth CAGR of 10.65%, and an annual share price appreciation of 10.57%. Realty Income represents the stability engine, offering dependable income and long-term resilience. With a 5.51% dividend yield, a 3.9% dividend growth rate, and 2.32% annual appreciation. Essential Properties Realty Trust serves as the innovation engine, driving faster growth through efficient modern property models. It combines a 4.07% dividend yield with a remarkable 15.23% dividend growth rate and 10.7% annual appreciation, injecting momentum and adaptability. Extra Space Storage completes the structure as the dividend engine, producing reliable income with a 4.53% dividend yield, 11.82% dividend growth, and 6.25% annual appreciation. The next step is to calculate the portfolio's overall dividend yield. To keep things simple, I'm taking an equal position in each of the four REITs, meaning we're investing the same amount of money into each one. That way, we can just use a plain average instead of a weighted formula. Here's how it works. Start by listing the dividend yield for each REIT. Prologis 3.53%, Realty Income 5.51%, Essential Properties 4.07%, and Extra Space Storage 4.53%. Now, add those four yields together. 3.53 plus 5.51 plus 4.07 plus 4.53 equals 17.64. Then divide that total by the number of REITs, which is 4. 17.64 divided by 4 equals 4.41%. And there you have it. The portfolio's average dividend yield is 4.41%. That's the combined income your portfolio produces when each REIT is equally represented. You can use the exact same approach to find the portfolio's average dividend growth rate and average share price appreciation as well. Using our data, those come out to a 10.4% dividend growth rate and a 7.46% annual share price appreciation. Now that the system is fully assembled, the next step is to see what really makes it powerful, how compounding turns single-digit contributions into long-term exponential growth. Let's say Josh invests $9 a day. That's about $270 a month. It doesn't sound like a lot, right? But that small, consistent habit is where everything starts. By the end of the first year, Josh would have invested $3,285. This sets the stage for future growth. By year 10, his portfolio is projected to reach roughly $60,000. By year 20, that same daily habit will be valued at about $290,000, nearly a third of $1 million. This is where the compounding starts to take effect, and by year 30, Josh's portfolio is projected to grow to around $1.4 million. Around the same time, this portfolio will be paying him close to $122,000 per year. That's over $10,000 a month in passive income. All of it coming from the same $9 a day routine. Want to know how to turn a one-time $500 investment into a portfolio that pays over $4,000 in monthly dividend income? Click the video on screen to find out.